Welcome to the Capital News. I am your host, Alex Corretas. Today is June 12th, 2019. Thank you so much for joining me. The Fed is confused. That's the title of today's episode. The Fed is confused, and we're going to get to that here shortly. The S&P closed down 6 points for the day. The Dow closed down 44. The NASDAQ lost 30. The Russell 2000, the small cap index, was able to gain 68 cents. The Dow Jones Transport was actually able to gain a little bit today, about a half a percentage point, and the New York Stock Exchange lost a quarter of a percentage point for the day. Oil continues its decline. We have WTI at $51.18, and we have Brent at $59.93, so it broke the $60 handle, so we're going to have to pay attention to these markets. Of course, this is on the back of increased U.S. crude stockpiles. Again, who's surprised? Not us, because we're very well in the loop and informed as to what is taking place in these markets. Yet somehow, it's still that word unexpected. Nobody is expecting this. It's only been taking place week after week after week, an increase in stockpiles, which is putting downward pressure on prices, which is what we have been seeing for the past several weeks now. And I imagine it will continue because we have a slowing economic picture, not just here in the United States, but globally, around the world. So this is the supply and demand function. We have an increase in supply. I believe we have lower demand because we have a slowing global economy. And right now you have the dollar that's a little bit mixed in value, but nevertheless it's still relatively high. And geopolitical risks, at least right now, seem to be on the back burner. So nothing is front page news right now. So as far as everything stays the same, we're going to continue to see downward movement in oil across the board. Gold is at $1,338 an ounce. Silver is at $14.74 an ounce. So the markets are still sort of waiting on pins and needles. There's no flight to safety. There's no panic right now. There's a lot of uncertainty, but it's not front page news. So the precious metals, they're still lingering right around those technical levels we're still monitoring here pretty closely. $1,300 for gold and $15 an ounce for silver. The U.S. 10-year Treasury was down slightly. It now sits at 2.127%. And the VIX lost about a half a percentage point today and now sits at $15.91. So a couple data points came out today. We have U.S. inflation is lower than expected. Do you think your cost of living has gone down? Do you? I mean, even if you think that's the case, I mean, if you go grocery shopping, I mean, look at the size of the portions. You know, look at a granola bar. Look at the size of the box, the cereal box, the bag, the potato chips, anything that you buy. Maybe the price has stayed the same, but has the size of that object gotten smaller? Has it stayed the same? Has it gotten bigger? It's probably gotten smaller, hasn't it? And chances are it probably has become more expensive. So it's a double whammy. You're getting less and you're paying more. Now, is anybody in Washington, D.C. going to tell you this? No, not even close. Is the Federal Reserve going to tell you this? No. Is the President going to tell you this? No. Is the Secretary of Commerce going to come out and tell you this? No. Treasury Secretary? No. Larry Kudlow? Not a chance. He just got pulled out of the Potomac. He's back in the good graces of President Trump. He's not going to come out and make that mistake. He's not going to tell you anything about that. But nevertheless, those are the headlines. U.S. inflation is lower than expected for the month of May. This gets to our topic for today with the Fed is confused, because we had one hell of a rally last week in the stock market, quite honestly the best of 2019, despite the fact that we have had a V-shaped recovery for most of 2019. Last week was the best week for those stock indices. Can't make this stuff up. Why? Because the markets were anticipating that the Federal Reserve is going to come once again to the rescue to bail out the stock market, that it's going to cut interest rates, and that it might even embark on another round of quantitative easing. We'll keep the quantitative easing part aside right now, because right now it's just front and center is more rate cuts. And we're not talking about 25 basis points. We're probably talking about more like 50 basis points, 75 basis points, or even 100 basis points. Now, of course, you have to remember, it wasn't very long ago that you had Larry Kudlow, some other members of the Trump administration, and the president himself making statements and tweeting out to the public that he believes that the Federal Reserve should cut interest rates by 50 basis points. Then, very shortly thereafter, 50 basis points wasn't enough. It has to be 100 basis points. So that's a full percentage point. Can't make this stuff up. The president wants to have it both ways. He wants to say that the economy is the best in U.S. history. He wants to claim that the GDP figure for the first quarter of 2019 was 3.2%. Okay, that is what they claimed, so that's what he's running on. He wants to talk about unemployment being at 49 and 50-year lows at 3.6%, and he wants to talk about low inflation, so prices are stable. Okay, now, why is the Fed confused? What's the Fed going to do? Because the markets are signaling that they want the Federal Reserve to cut interest rates. Why? I have no idea. Everything's supposedly A-OK. You have low unemployment, 3.6%. You have 3.2% GDP growth. Yes, you have all of these shenanigans with trade talks, but guess what? Donald Trump just indefinitely suspended increasing or implementing any types of tariffs on Mexican goods coming into the United States. So why would the Federal Reserve have to concern itself with those tariffs if they're indefinitely suspended? Right now, they simply don't have to worry about it. There's no reason to preempt anything. Trump pulled out that secret deal with Mexico. He's all happy about it. The Mexicans, of course, deny that there's any type of secret deal, that there's anything in addition to what we've already been told, that there's going to be an additional 6,000 Mexican troops placed at their southern border to Central America to stop the influx of illegal immigrants coming into Mexico and thereby making their way north to the United States, and a whole host of some other issues. But of course, we're still waiting on the Mexican legislature to see what happens there. But I don't want to get on a tangent on that. But nevertheless, that's removed because that caused a scare in the markets. They sold off. But then that caused a little bit of our translation that bad news is good news because the markets are looking for another shot of heroin, another dose of crack to come from the Federal Reserve to bail out Wall Street. So bad news was good news. The president alleviated some of that. Tariffs are indefinitely suspended. Okay. 3.2% GDP, 3.6% unemployment. The Federal Reserve has a dual mandate. Full employment, stable prices. You have 49 and 50-year record low unemployment rate. You have low inflation. That means stable prices. The lower the number, the more stable they are. So they check off all of these boxes. That's their mandate. That's their charter. Why are they concerned with a whole bunch of crybabies on Wall Street? Because these markets are rolling over and they say we need another dose of juice. Makes no sense whatsoever, but that's the world we live in. This is frat boy mentality. Somebody's throwing a party, they do not want it to end. They don't want to believe that they're going to be hungover, that they're going to get drunk, that they're going to wake up and they're going to be in a world of pain. They just want to continue to drink so they never feel the pain, so they don't get that hangover. Let's just keep drinking, let's just keep drinking, let's just keep this party going. All that's going to do is cause even more and more damage to the system, which is exactly what it has done over the past decade, and it's exactly what will continue to happen if the Federal Reserve does cut rates and or embark on another round of quantitative easing. And again, shame on the president for calling on the Federal Reserve to cut interest rates and to embark on another round of quantitative easing, when in fact one of the main reasons why I voted for the president, and I say this all the time, is because he attacked the Federal Reserve. He made mention to it. He made mention to low interest rates. He made mention to quantitative easing and how poor of a policy this was for the United States of America, middle America in particular. It was okay for the well-to-doers, such as President Trump and some other billionaires and multimillionaires, those who own a lot of financial assets, stocks, real estate, bonds, commodities, those types of things. Most Americans do not have two sticks to rub together when it comes to savings, unfortunately, and most people simply do not own financial assets or not in large enough sums to really make a big difference. That's why we have such wealth inequality in this country. It's because of low interest rates and quantitative easing. And candidate Trump identified this and articulated it very, very well. And that led me to support candidate Trump and to vote for him. Now he's president, and he wants them to embark on such flawed and fraudulent policies. It's a big problem for me. It might not be for you, but it is to me, because I strongly believe that I am correct in identifying a lot of the causes of the many structural issues that exist within this country. And at the forefront is the Federal Reserve and large government. So I simply cannot endorse the president when he comes out and says that the Federal Reserve needs to cut interest rates and needs to embark on another round of quantitative easing. I just don't believe that that's the right course of action. You can, of course, disagree with that. We can agree to disagree, perhaps. But I think it's the wrong policy. I think it's the wrong action. I think it's the wrong rhetoric. But again, we've had this conversation many times over that I believe that the president is doing this in part because he is trying to box himself out of taking ownership of the economy and the stock market, even though he has done both. Because he talks about the economy all the time and he talks about the stock market all the time. But he doesn't want to be responsible if and when the economy and or the stock market turn south. He wants to blame that on on politicians. He wants to blame that on endless wars. He wants to blame that on the Federal Reserve. And perhaps he's going to blame it on China because they weren't able to come together to make a deal, if that is what happens. So that leads us again back to why the Fed is confused. What's the Fed to do? We've just checked off all those boxes. Strong GDP figures, strong unemployment figures, decent inflation. Yeah, they're trying to target 2% inflation, but that's not their mandate. That's not their charter. So, and they said they were fine with it being a little bit below 2%, and they're going to be fine with it being a little above 2%. It's transitory, they said. It's temporary. It's not going to be forever. We anticipate inflation is going to pick up some point in the future. Okay, well, they're data dependent, supposedly. I don't know how true that is, but that's what they tell us, that they're data dependent. All right, well, having lower inflation, that sends a signal to the Federal Reserve that, you know what, you could cut interest rates. You could do it because inflation is so low. So you can, if you want to try to kickstart some inflation here, get it a little bit higher to that 2% target that you're trying to get to, you have some wiggle room. And conveniently, we had a very poor unemployment report, jobs report, last week when we only had 75,000 jobs created for the month of May. So that is also, maybe that's the beginning of, maybe this ice is starting to crack. It's starting to thin a little bit. Maybe the Federal Reserve can come to the quote-unquote rescue. There's some wiggle room. There's some justification. 75,000 jobs created in May, lower than expected inflation. You could do it, Federal Reserve. You can. You got the crybabies crying on Wall Street. You can do it. That's not in their charter to inflate financial assets, to bail out Wall Street. That's not in their charter at all. But this is what the Federal Reserve has been doing for the past decade. And so the crybabies have gotten used to it. This is why they had their temper tantrum in the fourth quarter of 2018, even though it has been broadcasted for a very long time that the Federal Reserve was going to continue to increase interest rates. They still threw a temper tantrum. The market sold off 10, 20%. Didn't like it. Here's an interesting question as to what's going to happen, because you have a lot of market analysts out there and a lot of very well-known, you got some billionaire hedge fund managers out there saying, look, if the Federal Reserve cuts interest rates, you're going to have a melt-up, which we've talked about here many times over, that there's going to be a rush into equities, into stocks, and you're going to see all-time highs. It's going to be a melt-up. That's what's going to happen. That's according to a hedge fund manager, Paul Tudor Jones. Will that happen? It's anybody's guess. Because here's an interesting take that I have not heard anybody talk about on the financial mainstream media. You have to understand that the Federal Reserve for the past couple of years has been in a hiking cycle. They have been increasing interest rates at a slow pace, 25 basis points here, 25 basis points there. Slowly but surely, they have been hiking. But nevertheless, we're only at 2.25% at the federal funds rate. I mean, 2.25% because we've been at zero interest rate policy for near a decade. So despite the fact that the Fed has been in a hiking cycle, we're only at 2.25%, 2.5%, okay? 2.25%, 2.5%, depending on the day, whatever they want to do. So we had stock prices reach record highs in 2018. We had them make new highs in regards to the S&P 500 and the NASDAQ make all-time highs only about a month and a half ago. This is during a rate hiking cycle that stocks made all-time highs. So follow me on this. The Federal Reserve has been increasing interest rates, yet stocks were still able to make all-time highs. They were also in a wait-and-see policy for the past several months, and stocks were able to retake and make new all-time highs again on the S&P 500 and in the NASDAQ. Now you have analysts out there saying, well, if the Federal Reserve cuts interest rates, that stocks are once again going to make all-time highs. You get where I'm going with this? This doesn't make a lot of sense. You can't really have it both ways, but that's what the markets are trying to have. So you can increase interest rates, and stocks will make all-time highs like they did in 2018 and they have here in 2019. And you can cut interest rates, and stocks will once again make all-time highs. So basically, the moral of the story is, regardless of what the Federal Reserve does, stocks can make all-time highs. That's ridiculous. You can't have it both ways. You simply cannot. Now, I know we're in the financial world of Oz. It can happen. It can happen. Will it be sustainable? No. It can't be sustainable because of economic laws. It's just not going to happen. Diminishing marginal returns will kick in. They've already kicked in as far as my analysis is concerned. It's just a matter of when the rest of the world wakes up to it and says, the emperor has no clothes, that this game, this song and dance is over, that the music has stopped and not too many people have a chair. So this is going to take time. We're early to the party. That's okay. It's better to be early than late. But nevertheless, this is what we have to deal with. So the Federal Reserve is somewhat confused because another thing that is sort of leading the markets to throw their hissy fit to sort of get the Federal Reserve to lower interest rates once again is the uncertainty surrounding the U.S.-China trade talks. What's going to happen? Well, we don't know. But we do know that the president is out there saying that he wants to have a trade deal and that he's saying that the Chinese want a trade deal and that the Chinese have to make a trade deal. And we have the G20 meeting coming up at the end of the month where both leaders are somewhat expected to meet, that being President Trump and President Xi of China. They are supposed to meet, have a sit down, have a discussion. Are they going to sign a trade deal? No, there is no trade deal. These guys aren't just going to hatch out everything in the course of a couple-hour meeting, if it's even that long, if they even meet. But of course, if they don't meet, the president has already threatened China that if President Xi does not meet with President Trump at the G20 meeting at the end of June, that he is going to increase tariffs on Chinese goods coming into the United States. So, the Federal Reserve is boxed in to some degree. Again, low unemployment, low inflation, so we have stable prices. That's their mandate. That's their charter. Nowhere is it written that they're here to bail out Wall Street. That just happens to be what they've been doing for the past decade at, of course, your expense. Middle America. At your expense. And now we have the president saying, yeah, well, keep doing it. Makes no sense to me whatsoever. So the Federal Reserve is confused. I think they're confused. I don't think they know what they're doing. Again, one of the main reasons why I think they should be abolished, get rid of them, you'll start to solve some problems. What are they going to do? Because they have a meeting next week. I am not anticipating that the Federal Reserve is going to cut interest rates next week. But we have market anticipating that the Federal Reserve in July probably will, during their meeting in July, that they will cut interest rates. This is really beyond the pale, because if we have such a strong economy, why was the hiking cycle so detrimental? Why was an additional 25 basis point increase? How could that knock off an economy that is supposedly humming along at the best rate that it's ever done, according to the president and his administration? Just doesn't make any sense. So something is amiss here. So how the Federal Reserve acts, what they say next week, everybody is going to be on pins and needles. Again, this is another reason why the Federal Reserve should not exist, because this is in your face an example that this is not, I repeat, not a system of free market capitalism. Because we are quite literally waiting for one person, Chairman Jay Powell of the Federal Reserve to come out and make a statement. And everybody is going to read through this statement and listen to every single word. And he's going to take some questions at a press conference. And everybody's going to listen and stop what they're doing and cling to every word that this guy says as to what is going to take place in the markets. That is not free market capitalism. That's some sort of financial dictatorship. That ain't the United States of America. And then you have President Trump on the other side tweeting and trying to dictate what the markets do. And again, he was out there again today trying to elevate these markets because, again, these markets are in a state of flux. They do not know which way to go because they're starting to digest a lot of the economic data that we talk about here on a daily basis. And they're saying, that ain't pretty. And they're saying it ain't pretty because that's the truth. It ain't pretty. And if this stock market really followed the underlying economy, which is how it's supposed to behave, we would have seen a sell-off, a big sell-off. We probably would have retouched the lows of 2018. We maybe even have gone below that, which is what I'm anticipating is going to happen at some point. The question is when, because we have a lot of financial engineering taking place. We got a lot of fraud taking place. We got the president trying to egg on the Federal Reserve to cut interest rates, embark on another round of quantitative easing. We have the Federal Reserve coming out, Chairman Jay Powell and other members of the Federal Reserve coming out and telling the markets, hey, listen, we hear you. We see what you're saying. We see what's going on. We understand that there's a lot of uncertainty. We understand that the president goes off on the weekend and we don't know what he's going to say, what he's going to tweet. We understand. We stand at the ready to do what's necessary. And that's why we have seen last week the largest rally in stocks, because the Federal Reserve is promising to come to the rescue. Stock prices cannot decline. That says to me that they can and that they will. The only question is, when will that happen? When will the fundamentals finally catch up with everybody? Because they're going to. They've been able to financial engineer this system for quite a while. We've had these conversations here all the time. That's exactly what this podcast is about, especially the economic podcast. We have trillions of dollars of debt sitting on the books of corporate America. $10 trillion. That's bonds, that's commercial and industrial loans, that's leveraged loans, that's everything under the sun. $10 trillion. And guess what? It's all coming due starting this year. So it has been coming due this year, and now you're going to see trillions of dollars coming due over the course of the next few years. At the end of a business cycle, at the end of a credit cycle, and we have trillion-dollar deficits, federal deficits to boot with no end in sight. So where's the growth going to come from? It's not going to be there. It's just simply not going to be there. And I've come across some other things regarding the auto industry, which is, of course, a main driver of economies the world over, especially industrialized economies that have a vibrant automobile sector. We have, I believe, a record number of auto leases that are going to be expiring this year. So what does that mean? That means we're going to have a glut of used car supply. It's going to be just a glut of used cars sitting on the marketplace. That's going to put prices, that's going to put downward pressure on used cars. So that is going to make used cars quite competitive up against new vehicles. You get where I'm going here? You already have the consumer, the world over, especially the American consumer, who is tapped out. They just have too much debt. Credit card debt, student debt, any type of debt. Auto debt. They have too much auto debt as it is. What do you think they're going to do? You think they're going to go for that shiny new car that they cannot afford? They're already tapped out, mind you. They tried doing that before. Now they're tapped out. You think they're going to go back to get a new car for $30,000, $32,000, $35,000? They cannot afford it? Or do you think they might go and say, you know what, look, there's all of these cars now sitting on the lot that are used. They were leases, so, they probably only have about 36 to 40,000 miles on them. Maybe only one driver, good shape. And it's a hell of a lot cheaper than $30,000, $32,000. I think I'm going to go with the used car. So you're going to have a lot of downward pressure, not only on used cars, but on new cars. How do you think that's going to fare for the auto industry? It's not going to fare too well. We've only started to see a blip of this in the auto industry, and we're talking about massive layoffs the world over. Wait until this transpires. And look at all of the debt that is owed by these companies. How are they going to solve this? Well, they're going to lay people off because they got to make good on their payments because that's a contract. They're not contracted to keep you employed, but they're contracted to pay off their debt. So this is going to have major downstream ramifications. It will revert throughout the entire global economy. We're already starting to see that. Nobody wants to talk about it. And then you have a whole other issues with the banking crises that could be taking place. You got to pay attention to Deutsche Bank. We talk about that here quite a bit too. I don't want to get off on topic, but you have to pay attention to all of these moving pieces because nothing is done in isolation. This is a very dynamic, very fluid situation. I think at the end of the day, most of this trade talk is just smoke and mirrors because, who cares about these soybeans in pork bellies, okay? All right, yeah, it might benefit some farmers here and there, and I don't want anybody to, suffer, but guess what? Excuse me, if you look at the farming sector, you have had record bankruptcies, especially the small farmers out there, just record bankruptcies over the past 18 months. And that's not good. And, of course, because we're in these quote-unquote trade negotiations with China and others, you have the administration now bailing out farmers to the tunes of billions and billions of dollars. So we're subsidizing our side. The president wants to ridicule the Chinese for subsidizing their industries. Well, guess what? We're doing it here. We're doing the same thing here. So that's the pot calling the kettle black. That stuff doesn't work for me. I don't like the hypocrisy. I don't like the double standard. But nevertheless, that's the world in which we live in. It's going to be very interesting to see how the Federal Reserve responds to all of this because they have a mandate. Given their own figures, they've succeeded. But there's also this secret mandate that they're here to bail out the Wall Street. Will they continue to do it? If they attempt to do it, will it work? That's the ultimate question. And that remains to be unknown. But that's something we're going to stay on top of because we're going to know next week. So stay tuned and join me again tomorrow. We'll be back, and hopefully it's a little bit less chaotic in the markets. Hopefully President Trump isn't threatening the Mexicans, the Chinese, the Germans, or anybody else for that matter. But you know what? We'll see what happens. Thank you so much for joining me. This is the Capital News. I am Alex Kreitis. Godspeed.